I think that Ethereum can generate a lot of transaction fees if it catches on and it becomes kind of the base layer first for DeFi and maybe in the future for like large parts of kind of the internet itself, and like just become the platform on which many things are built, and like a lot of applications, a lot of businesses kind of host their application logic. And yeah, I'm like really bullish, I think, on this future. I just don't think that you can really, I don't see by which mechanism you basically say that like, oh, ETH should play a big role in this. Like, you know, like people are not all of a sudden gonna prefer holding ETH over dollars or over stocks or over index funds or over, you know, anything really, right? Or like they will not also prefer trading it against that. Like there's, you know, you need to basically go to what people want to do and what problem does ETH solve for people.
Here we're with Hasu, strategic advisor to Lido and Flashbot. Hasu, it's great to have you back on the Defiant Podcast. Welcome.
Camila, thank you. Thanks for having me back.
Yeah, always great to have you. You know, you are very deep in one of Ethereum's biggest protocols, Lido. Can we just start by getting everyone on the same page about what Lido is?
Yeah, so Lido is the largest decentralized staking pool in Ethereum. It's trusted by around 25% of all stakers. And what makes Lido special, you know, one, it's decentralized, so it's fully non-custodial. When you give your stake to the protocol, it's distributed across a bunch of different node operators, but you can always take the LDO back and you can hold it. You can always take the ETH back and you can hold it in self-custody. And the other big thing that makes Lido different is it's liquid staking. So when you stake, let's say on Coinbase or Binance or some other more centralized provider, then you can, you know, also unstake at any time, but you cannot use the stake while it's sitting with this provider. And how Lido is different is you get a liquid staking token. In this case, it's called staked ETH. You get that into your wallet and you can use that in one of many different DeFi integrations. So for example, you can borrow against it on Aave or other lending protocols. You can swap it. You can stake it to earn additional yield even. And so, yeah, it's more capital efficient. For that reason, many people, you know, engage in strategies like looping, which is borrow against your staked ETH to borrow more ETH, and then, you know, stake that to get more staked ETH, etc. So it's very popular with all the liquid staking tokens, this strategy. And so if you're like a smaller, you know, user, then you would mostly kind of engage in these liquid strategies. But for bigger players, you know, like exchange traded products, for example, they have also kind of withdrawal rules or like redemption rules that they need to serve from their regulators. And so for them, the liquidity is also, you can think of it as a second kind of exit door from the protocol, because when you stake normally, you know, it can, depending on the size of the withdrawal queue, how congested it is, it can take up to weeks to get your money out. And when you have staked ETH, then you can not only unstake it the normal way, but you can also sell it on the market, right? So that gives you an additional way to exit your stake, which is a type of flexibility that I think especially bigger users and institutions really value in Lido as well.
Perfect. Okay, now I'd love to dive into one of the latest developments in Lido, which is a change in governance. And this is especially important given what you've mentioned, that 25% of stakers are using Lido. Mm-hmm. So it's crucial to have a very robust and decentralized and censorship-resistant governance systems. Mm-hmm. What's the implications for the latest governance change?
Right. So we recently released Dual Governance, which is a protocol upgrade that's been in development for, I think, over 3 years at this point, from idea stage to final implementation. So it's a really big deal for us. And so why is, you know, basically in a nutshell, Dual Governance gives stakers the ability to always veto any proposal that happens in the Lido DAO, which is the DAO that's governing the upgradability of the Lido smart contract system. And it guarantees that if enough stakers disagree with a proposal, that they always can exit in time. And so why is that important? So first, you know, governance, like staked ETH, the token, it has a certain security surface that is basically controlled by governance. And that is a risk for these stakers, right? So in the beginning, we talked about how Lido is more liquid than forms of direct staking. But in the past, the benefit of direct staking was that because there's no smart contracts involved, you don't need any upgradability. So this one is actually like fully secure against any type of governance attack. And so the way that other smart contracts, handle this is, they just make, they make the smart contract immutable. So if you look at Uniswap, for example, Uniswap pool is immutable, right? So there's never any risk that the Uniswap DAO or the Uniswap Labs kind of upgrades your smart contract in a way that would be bad for you. The other way is you need to have it upgradable, but you just install what's called a time lock. So you just proposal passes, but then still, there's a week or two before it becomes executed where people can look at the changes and say, if those changes, I don't like them, then they can still leave. So with Lido, first of all, you need the smart contracts to be upgradable. And it's not for any choice of ours, but it's because the Ethereum protocol itself is changing. And staking implementation, like the decentralized staking pool kind of needs to be upgraded in order to even stay compatible with the changes that the Ethereum developers make. And maybe at some point that's no longer the case, and I think we're looking forward to that day. And the second problem we'd already hinted at is just the Ethereum exit queue has a variable length depending on how many people want to unstake. That's because Ethereum doesn't want too many people to withdraw at the same time, because then they worry that basically the consensus could become unstable. And so basically for Lido, it would be very hard to make a time lock that's long enough so that everybody can withdraw before every proposal. And so the key insight behind dual governance is where you still want to have a time lock, but what if you can make it dynamic? So if the proposal is good, it's harmless and it's good for the stakers and the protocol, then it can just pass right away. But if anybody's concerned about the proposal, then it basically, you have a longer time lock. And if enough people say, guys, we're really worried about this proposal, a lot of us are quite worried, then the governance just stops entirely. And so the way that it's implemented is people can deposit their staked ETH or rep staked ETH or their withdrawal NFTs from Lido. They put it in a smart contract that you can access. If you go to dg.lido.fi, DG meaning dual governance, and you can just, put your staked ETH there in a escrow contract. And if 1% of all the stakers deposit in there, then the protocol enters the state that's called veto signaling. And then the governance is basically paused for between 5 to 45 days, depending on how many people deposit. And if 10% of stakers have deposited in this contract, meaning either some very big stakers disagree or enough small stakers disagree, then the governance just becomes frozen entirely. And it stays frozen until everybody from this escrow has withdrawn their stake. So nobody disagrees anymore. And so what it means in principle is that the risk of any kind of smart contract, if any smart contract changes that are bad for the stakers happening, is just it's massively reduced, right? So neither the Lido DAO can do anything. For example, let's say, increase the fees by 10x, right? That would be very bad for stakers and would be a clear instances where they just disagree. But also a governance attack, maybe from the outside or something. Somebody manages to sneak in a kind of malicious attack. All of this can be now much more easily prevented. And so when I was saying in the beginning that there used to be this trade-off, either you do direct staking, but then you don't have liquidity, or you get the liquidity, but then, you have to take a hit in the security because you're exposed to the additional smart contract risk. I think dual governance basically solves this dilemma entirely. So you can now have the liquidity of a liquid staking token, but with the security of direct staking. And so I think this is a really big deal for stakers, especially those who care, a lot about liquidity and security.
Super interesting. A couple of follow-up questions. One, how much participation do you usually get in governance? So, I'm thinking about stakers who might just be holding staked ETH but aren't really aware of what's happening in Lido, and maybe there is a proposal that would harm them, but they don't even know what to do or how to participate. So I'm wondering how engaged validators are. And the second follow-up is whether there's any chance that how immutable are these mechanisms themselves, right? Mm-hmm. Maybe, these time locks are in place, but at the time that you really need them, maybe there can be some sort of attack to.
Yeah. Okay, so regarding your first question, so right now only the LDO token holders are voting in governance, and propose like there's a 5% quorum, so 5% of LDO holders need to agree to pass a vote. And the quorum, like it's always 5% of people voting. Why? Because I mean, if already 5% voted, proposal is already passing. The incentive for more people to vote is basically it doesn't exist, right? So the thing to understand, like with LDO, only LDO holders can pass new proposals, and the stake DEF holders can basically indefinitely like time lock the protocol. So if they don't like the active proposals, then they can block it until they had the time to leave, which is what matters basically for them. But they can't make any proposals that would be bad for the DAO themselves. So that is only. Basically, you have this like bicameral system now where like one party can propose, but then the other party can basically veto. And so I think that's very helpful. So I think that what you're getting at with your question is like, are these maybe numbers too high, like 1% and 10%? Are enough people even like paying attention to what those things are? So there was a bunch of kind of, nothing like this has been built before, right? And so there was a bunch of kind of modeling involved from the Lido side to arrive at the right numbers that are like not too high, that basically you need to activate too many people to do it, but also not too low, so that like it's very easy kind of to grief the protocol and like slow everything down. And also it should be kind of robust to one single party that's like let's say like a big lending pool getting hacked and like staked ETH kind of taken from there, that it's also like robust against something like that. So like in our mind, like it turned out that 1%, there's a bunch of even in like individual holders who hold more than 1% of staked ETH, and like it's so getting that like kind of triggered is like not that hard. And then from there, via social media, etc., I think it's relatively it's possible to kind of activate the necessary 10%. And you have more time, right? So every time like the number of people in the escrow contract goes up, also the time lock extends up to 45 days. So you have a lot of time to reach the 10%. Like 1.5 months is a long time in crypto.
That's true. And you're right that social media, at least, or X, does serve as this sort of town hall where, at least you get a decent chunk of people are aware and participating.
Yeah, I mean, I think that, if a dual governance actually activated in Lido, I think even like the Defiant would write about it, because I think
Definitely,
it would be very spicy, yeah.
That'd be a fun story.
So regarding the third part of your question, are these, is this smart contract actually immutable or can it be gamed? So no, it is immutable. It's actually like part of the way that the Lido smart contract is upgraded. Can only be upgraded through this process that is, you need the Aragon kind of Lido contract kind of to, you have Aragon voting whenever you want to upgrade the Lido smart contract. So the token holders need to agree, and then the staked ETH holders can disagree. And so this is now part of the upgrade process, and like this could be changed, but it requires itself like an on-chain vote, right? So like, already like, LDO holders would need to agree to change it, and staked ETH holders would have to not disagree to change it. And then it can be changed, but there's no other way that it can be changed. Same as like nothing else in Lido can be changed outside of this process now.
Got it. Is this already implemented?
Yeah, so the vote passed last week on Monday. So it's now live. So yeah, you can go to dg.lido.fi and can read like, this is the smart contract that you can deposit in. It's permissionless, like in its non-custodial. And you can read the instructions there, and you can see how many other what proposals are currently live being voted on, how many other people have deposited in the contract, and how long the time lock lasts. Like this is your portal basically for engaging with this. And I think if you if you hold staked ETH, I think this might be a good idea to bookmark this and just like so you know where to go.
Cool. Have there been cases in the past where you think this change would have been useful? Like, have there been like controversial upgrades in the past?
So no, I don't think so. The thing is, so this secures basically against two things. One is, I think, big tail risks. So let's say there's like actually like malicious proposal happening, maybe because like somebody hacked enough LDO tokens, or somebody, found a way to like sneak something like that in the protocol. And like this has not happened. And if it had, then probably Lido wouldn't be like around anymore.
Okay, so
Because
it's,
this stuff is
it's like for like really big edge cases.
Yeah, and like this is the one area where I think this is like extremely helpful, right? It's like when a big edge case happens, just a governance attack, let's say, or hostile takeover, then it would be supremely useful, but it hasn't happened. And if it had, then there's a high chance that Lido wouldn't be here anymore.
Got it. Okay.
But the other thing is just, let's say there's almost like, like an activist investor who says, oh, but like, why does Lido charge only 10% of fees to stakers? Shouldn't it charge like 50%? And so they make this proposal, and it's not evil, right? In the sense that, they just think it's like better, and, but then the stakers can still disagree with this and it wouldn't pass. And so I think this is, so even like, kind of like not technically malicious, but just like proposals that the stakers don't like now are very hard to pass. So this, for example, I think doesn't mean that Lido can like never raise the fees, but you need to have like a strong rationale that the stakers actually agree with, right? So, if you say we're going to raise, fees by 2% because we want to invest in the way that makes this protocol better for you, makes it more liquid, more integrations, whatever, then, like it needs to grow the pie, and that's important. So everything can still pass if the stakers think it's good, but if the stakers think it's a bad idea for them, then now it's just very, very difficult to pass anything. Super
interesting. I wanted to get back to the point about, how much of staked ETH is in Lido. With 25% of staking concentrated in the protocol. Are there systemic risks to Ethereum of having so much of ETH in one protocol?
Yeah, so I mean, I think it's a nuanced question. I think there used to be like a big debate about this a couple of years ago. And so, I mean, in general, when like a centralized actor controls a lot of stake, I think the risk is there's a non-zero risk. It can still be decentralized in the sense that like non-custodial for the user. So it's not like they can steal all this. But if they can control the way that blocks are proposed, for example, or like attestations are made and they cross certain thresholds in the protocol, and there are things that they can do to like hurt the consensus, make the chain not finalized or something like that. Again, in practice, the incentives to do any such attack are basically non-existent because the social consensus of the blockchain can always kind of override that. You will still get slashed, and you can also be socially slashed because it's very attributable basically to like a single party. So I've always thought this is mainly like an optical concern for some people. It's not a real concern. Like if you wanted to hurt Ethereum, there would be much better ways to kind of do such an attack rather than kind of misappropriating like funds trusted to you by your staking customers. When you have a business that's like working very well, it just doesn't make any sense. So that said, I think if we have an actually decentralized staking protocol, then of course those risks even are like much smaller yet, right? So because in Lido, you give your ETH to a protocol and it automatically distributes it to hundreds of different node operators, and those node operators all decide on their own what blocks they want to produce, and they don't, there's I think the biggest node operator has like 1% of stake in Lido. And so it's, there's no coordination between them, and there's no control exerted by the Lido protocol over those node operators. There are some rules that they have to follow. So they have to pay all the rewards basically to a Lido address. Because that's how we basically make sure that they don't funnel away some rewards away from the stakers they belong to, right? But apart from that, there's no pressure exerted on them. So I think in general, this issue has become like much, I think, less important in the community than it was a couple of years ago. I think there was a big kind of scare, I think 2-3 years ago when Lido was still like hadn't been around as long and it was at a similar market share, and people were like, yeah, okay, this is clearly going to grow to like 50% and then 100%. Because liquid staking has a lot of network effect and all the staking configurations are like the same. So you would always kind of favor like, everybody will like hold the same token, and because it's more liquid, everybody will kind of switch to that. And I think in reality, like that just hasn't happened. So I think if anything, then it turns out that there are more different ways that people want to stake. Like some people actually prefer direct staking, some prefer exchange staking, some prefer liquid staking, some prefer restaking, some prefer like more customized kind of setups. Like we can get into that when we talk about Lido V3, because Lido V3 is basically our response to this change in the market. But yeah, like it turns out that I think the marginal value of liquidity tapers off much faster than people expected. And like Lido is kind of at a, roughly similar market share than it was like, 3 years ago or 3 years ago. And so I think this risk that any one provider is like going to grow to like 100% market share, I think that's not really happening. And then, I think in a lot of ways also Lido makes Ethereum better, especially if you compare to a realistic baseline. So I think a lot of people a couple of years ago were still like, yeah, but it looks like we would rather have everybody just solo staking, or like if there were like 100 or like 1% providers or like even 10% providers. But then it turns out, there was it's like never realistic, right? Like the stake will always kind of centralize somewhere because there's economies of scale and there's brand and people want to go like with the brand that they trust and that's convenient for you and all those things. I think it's just a matter of like which providers are kind of, getting like 20, 30, 40% market share. You can't really avoid it. And with Lido, or liquid staking in particular, I think, it really lowers the barriers to entry in staking. Like it's actually, we make it easier to be kind of a solo staker because you can actually, like by engaging kind of in Lido as a solo staker, you can stake some of your own money and then you can also get money from Lido to stake. And so we're effectively giving you leverage on what you're already doing and you're controlling like everything yourself. And if you're a user/staker, then you can just, give the money to a protocol. It's fully non-custodial and decentralized. You don't have to worry about it. Every day, just the balance in your wallet will go up and you're contributing to the decentralization of Ethereum. And yeah, the node operator set, if you look like at the node operators inside Lido, it's much more distributed geographically. There's a higher client diversity. There's kind of fewer nodes in the big data centers and more self-hosting and like all of the things that we care about than actually like outside of Lido. Why? Well, because we actually care about this, right? So we want to make the Ethereum like validator set as decentralized as possible. And so we can make some rules inside Lido. And then, this is how we distribute the stake. And it's just very like good for Ethereum. I think that, I don't want to say there are no risks, but I think especially if it's a decentralized staking pool, then those risks are like not very big, especially compared to the benefits that you're getting from this as well.
The PR Genius is a top crypto PR and growth marketing agency, helping brands globally with expert PR and strategic growth marketing. They've worked with 300 plus projects like Movement Labs and IO.net. Unlike traditional agencies, they charge only on performance. Their services include earned PR opportunities and marketing services to help boost wallet holders and organic X followers. Learn more at www.theprgenius.com.
What about how open the system is to actually becoming a node operator? Can anyone do this? Like, what are the requirements?
Yeah, so there's two types of node operator right now in Lido. We have a module that's called the curated set. And so this is generally for professional node operators. They can apply and then like twice per year, they can be added to the set if they basically follow if they meet certain criteria in terms of quality. The other way is you can actually be a home staker and this is completely permissionless. And so actually you could like with the home staking setup, go to CSM, I think it's csm.lido.fi. And you can basically like register there your validator. And if you select the right kind of reward address, you will get some stake from Lido and you will have some stake of your own that's used as collateral, basically to kind of make sure you're not getting slashed or something. Yeah. And then you can actually participate in this. And CSM launched a couple of months ago only, and it's already maxed out its cap twice. So it's now at 2% of Lido share, and we're going to keep increasing it. Because it's like a very capital efficient way of doing it. Like it's permissionless, which we generally much prefer. And it's also very capital efficient because like people bring like some of their own stake to Lido. Lido gives them some stake, but they bring their own stake and they operate the nodes at home. And it's, I think just like overall really good.
Is that related to the distributed validator technology that you mentioned, or how does that work?
Yeah, so distributed validator technology for our listeners, I mean, it's basically a way of if you know how like a multi-sig smart contract works, multiple people like controlling the same key. This is the equivalent of multiple parties being able to control the same validator. And so they can propose blocks together and like make attestation decisions together. And this is generally good, I mean, for the security, because it's, much harder to, let's say, behave for one party. But this also improves like the operational efficiency, because it's, even if like, let's say you're in a like DVT setup with 4 other people, and like 1 or 2 of them maybe go offline and miss their slot, as long as the other 3 kind of still decide to sign like the block, then you will still build the block, right? And so it's really like a way of kind of driving operational efficiency. So DVT, we use it in Lido in its own module. So we have a DVT module, and it's basically, this was a way of basically testing this in Lido in a kind of more controlled way. And so this was like all specific kind of, only node operators that use DVT and kind of wanted to pioneer this for Ethereum. But increasingly, DVT is actually just, used in all of the modules. We allow, in the curated set or the CSM module, we allow people to use DVT, and it kind of, makes their setups more robust and improves. It just improves at the end of the day, like the bottom line of Lido, right? And like what money that we can make for the stakers. And it's good for Ethereum because like there's fewer, like, let's say, missed slots. It's very hard to get slashed, whether by intention or by accident. So it's just like, it's very useful. I think the kind of challenge or like the difficulty is, so you have almost like 2 tiers of DVT, right? So like, let's say you have maybe 5 different machines and you just like connect those together with DVT, but it's all your own kind of setup on your own premise, right? Or on your rented server in a data center. Then this is like, could almost like call this like tier 1 DVT, and it's still useful. Like it's still helping with the operational efficiency, but it doesn't help with this like you specifically kind of wanting to do something that would be bad, right? And so there's this other kind of even more useful and expansive tier of DVT where it's actually you and 4 other people who you don't even know kind of being in a set together, right? And so doing this and like coordinating this across many different node operators who maybe not even know each other, coordinating this, getting them signed up. I think this is like a challenge that Lido is also working on. And that's, if you want to get really like the full value out of DVT, then you need a lot of infrastructure for this kind of, coordinating at first, like in a more kind of, centrally managed way, but then giving people kind of the tools to do it all on their own, and like discovering kind of their peers and setting this up and testing it. And so, that's something that we want to do to eventually, I think, scale this everywhere. Like, I think this can just be, if it works, it's just like part of the like baseline kind of setup that everybody will use.
Cool. So, we've talked a lot about how Lido is working to reduce the risk that it may pose to Ethereum and validators with this new governance system, with DVT. But, there's still this, there's kind of growing discussion about whether there just should be a maximum cap of staked ETH. I had Justin Drake on the podcast a few months ago, and he discussed this, saying that he doesn't think there should be more than 50% of ETH staked at all. And so he wants to decrease the amount of issuance that goes to validators to kind of disincentivize staking when ETH reaches 50% of when more than 50% of ETH is staked. So when he mentioned this, the first thought was like, oh, I wonder what Lido thinks of this. So I wanted to get your reactions to this proposal.
Yeah, there have been actually a bunch of different, there have been a lot of proposals kind of in this direction, and I think it kind of people trying to figure out a little bit what they want. So, in my view, I think in Ethereum, folks on the like research side are generally a little bit worried about what happens if like too much ETH is staked. And the number one argument they give is, the number one argument I would say they give is like other tokens will then like replace ETH as collateral, and like ETH should have this special status in the protocol. Like this argument in particular has never kind of really resonated with me, because ETH is being replaced as the main collateral anyway. First of all, like I think stable coins are actually about to flip ETH in market cap, including like in DeFi as well, like as collateral if you look in like lending markets. And this will just be like, there's only one direction like this can go, right? Like, we all, I think, expect that ETH will play a very small role kind of in the future of DeFi, because like people want to get leverage on all kinds of assets, right? If you just look in TradFi, then that's what you see. Second, like, if ETH is in if ETH is in a smart contract, it can be upgraded, or ETH is in a roll-up bridge, or ETH is in a centralized exchange wallet. I mean, these are all different ways of like encumbering the ETH. And it's like, this idea that there's all of this like pristine ETH and it has this great security property, I think is just, is A, not true today, and B, is not, if you play it out into the future, is anyway like not really, doesn't matter that much. And then I think if you look actually like in other chains, ETH is like the total anomaly in terms of like that there's only, I think we have around 30% staked right now. Like I think it's like the total anomaly, how little is staked in Ethereum. And for example, Solana, which is a much younger network, has 70% staked. And it's fine. What is kind of seen as bad by some Ethereum people is actually a design goal for other people. Like they just want staking kind of to be as democratized as possible. They are saying that if we kind of, like they want this, like the staking, the people who stake and the people who actually own the currency, they want the set to be like, as overlapping as possible to kind of align the incentives. And they also like think it's generally good for DeFi if kind of there's a way to get yield on their native token. So there's like a bunch of reasons why this is actually like a design goal for other chains and it's working great for them. But in Ethereum, we're like more worried about what happens to ETH.
I think that the argument was that they see as 50% being enough to for like security purposes. And so that they see it as inefficient if more than 50% is staked. And as you said, they would rather that ETH be used across DeFi or for payments or whatever, like in other ways, and not be kind of locked up, staked away.
Yeah, I mean, but you can still use it for all of these things, even if it's staked, right? That's kind of
Thanks
so first
to
of all,
staking.
First of all, you don't need like that much ETH to do these things because people want to like use stable coins or other tokens for them anyway. Mm-hmm. And it's kind of an illusion that like, well, if you just allow people to use ETH, they will use ETH for these things. Like, no, like nobody wants to do all this stuff against ETH. Like ETH is being replaced everywhere. Like, it's no longer really used, as a dominant trading pair in DeFi. Because why would I prefer to like make a liquidity pool against ETH? Like, because it's much more risk, right? Like, if I can do it against USD instead. And so, I just think this argument is kind of not that great. The other big one, I think this is more like the argument of kind of, so if you're on the other side and you say, I'm really like against kind of capping of the staking rate, then the main argument from that side is mostly, so the lower you cap the staking rate, the more centralized your node operator set will become. And if you look at a kind of most extreme example of this, so let's say only 5% of ETH are allowed to be staked. And you do this by after like 5%, just the rewards go just like very low or even negative, right? Then what happens is the people who can make the most money from staking will replace everybody else, right? So like who can make the most money from staking? It will be people who basically, host it all in one data center and to engage in like the most risky behavior with their ETH. So maybe it's like restaked and it's like restaked multiple times and it's like leveraged and it's like using every sidecar and like points farming and whatnot, right? So you're trying to really like, the protocol forces you to kind of juice like the absolute maximum from your ETH, right? And so is this like the best thing for the protocol? I don't think so, right? So censorship resistance and decentralization are really core properties that make Ethereum different from other chains. And I think it needs to really like protect these properties. And you generally get a much more diverse node operator set and like less of this kind of price pressure if you just allow like a bigger staking market. Because then people will have more diverse preferences for what they want to do. All of those like super kind of like yield-seeking people still exist, right? And you still have centralized setups, but you also have more room for like more decentralized systems to also coexist and things that have like a lower margin or that like don't engage in all the riskiest stuff. So that's kind of the trade-off there. So that said, I think I don't hate the idea of like capping it at 50%. I think at 50%, probably you get a bunch of the benefits that I talked about without necessarily incurring those downsides per se. And if you look right now, like we're at 30%, we have actually been at 30% roughly for, I think, the last 9 months. So it's not like, ETH staking rate is exploding or anything. So I think that what I probably like, what I'm generally in favor of just like letting the staking rate like run anywhere. Like, I don't think it's bad to have a high staking rate, because I know all these other networks, they have a high staking rate and it's like totally fine. They actually get a lot of value from it. And so, but because of how far away we are from 50%, and I don't really expect us to really run against this barrier anytime soon, I think it's probably fine. So I don't hate the proposal, but I think I'm more leaning towards the camp that actually high staking rate is totally fine.
Got it. Yeah, I don't know. I think I see merits to both, but I'm interested to dive into what you think the role of ETH is, because you mentioned how you believe that it doesn't need to have a huge role in DeFi, and I think that's a it could be seen as a bit of a controversial take. So would love to kind of get more of your thoughts on that.
Yeah, I mean, I think that ETH is always going to play a role in DeFi, but it's just going to be kind of eclipsed by all of these other assets coming into DeFi as well that are much bigger in the real world. And so I don't think you should see it as kind of me saying that I'm bearish on ETH or anything. Like, I know I'm really bullish on DeFi. And so that's more the reason. And like Ethereum becoming the home of DeFi. And so I think the role of Ethereum is the primary role will honestly be just like an ownership share in the network. Like, and basically access to, I mean, so on the one hand, it's like used in staking to secure the network. And on the other hand, it's just giving you like access to kind of the cash flows from buybacks that happens through 1559, which is, fees being paid on Ethereum, the protocol burns in order to pay to ETH holders. And so, even if that's like its primary role, that would be totally fine. And I think that Ethereum can generate a lot of transaction fees if it catches on and it becomes kind of the base layer first for DeFi, and maybe in the future for like large parts of kind of the internet itself, and like just become the platform on which many things are built, and like a lot of applications, a lot of businesses kind of host their application logic. And yeah, I'm like really bullish, I think, on this future. I just don't think that you can really, I don't see by which mechanism you basically say that like, oh, ETH should play a big role in this. Like, like people are not all of a sudden gonna prefer holding ETH over dollars or over stocks or over index funds or over, anything really, right? Or like they will not also prefer trading it against that. Like there's, you need to basically go to what people want to do and what problem does ETH solve for people. So it is basically more immutable, right? It's more censorship resistant than holding other stuff on chain. And so there is a need for that, right? So I'm not gonna minimize that. So there are people who basically want to hold something that cannot be kind of confiscated by someone else. And ETH plays that role the same way that Bitcoin plays it. I think Bitcoin probably plays it better, right? So maybe ETH can rival that in the future. But right now, if I just want to hold, if I want a Swiss bank in my pocket, Swiss bank account in my pocket, I want to have money that nobody else can take. Probably I'm actually in the camp that I want to hold both Bitcoin and ETH, because Ethereum, like Bitcoin is like probably as a network is even more decentralized and robust and like unlikely to change. But in Ethereum, I really like the way that I can program the way that like I custody my funds. So that's really a great feature of Ethereum. The fact that I can have a custody setup that doesn't actually have a private key, that only, I don't need to have a physical copy. I can have like elaborate kind of social recovery setups and I can program my own spending limits. And like, we don't have that in Bitcoin, right? And I think we may get it if like something like OpCTV eventually makes it in the protocol, which I think it will. But, right now this stuff is like not really possible to do on Bitcoin, and on Ethereum it's super democratized. So I think this is actually like a really underrated aspect of Ethereum. But yeah, like this use case is just, even if you look at like how many people hold gold for similar reasons, like in the real world, gold is absolutely tiny, like compared to, like just like the dollar or, stocks or even, to many other asset classes. And that's why I think basically that like, Ethereum will not eclipse, for the very similar reason, like Ethereum has a smaller role to play as well.
So, to clarify, you view Ethereum's role primarily as a place for programmable money, right? For DeFi. And so like ETH is attractive for the fees, for the access to the revenue generated, the fees generated on the network because of people are transacting and building there.
Yeah, so Ethereum, the blockchain and like the ecosystem, I think has a good chance at becoming, what we call the world computer. World settlement layer, whatever you want to call it. And I think that DeFi is the first, is the first use case in that, but it won't be the last. Like DeFi is just such good kind of product market fit for Ethereum and crypto in general, because there's, a lot of value transferred, and it really benefits from permissionless innovation because it's so highly regulated and so fragmented and such, like, basically it's so common that in this way that like people are abused through kind of confiscations or censorship or inflation, and like for all those reasons, I think like DeFi really hits kind of a mark, and this is already like the breakthrough use case for crypto in many ways, with like stable coins in particular. But it doesn't mean that I think it's going to end there, right? I think the same way that everything moved, everything's becoming like software, and it started like moving to the cloud. I could see a similar trend happen in the future with crypto, is that this technology just becomes part of like every stack, just the way that like important software is written, where, if you want people to trust it, it's going to be on Ethereum or like a similarly kind of established blockchain. And I think you can attract a ton of, like, if you get these use cases, it will be extremely valuable for Ethereum. And even if everybody pays like a small fee, even if it's just a cent, if there's millions of transactions like per second, which is totally feasible, or even like sub-cent, right? Then you can still build one of the basically most valuable businesses in the world, or in the history even. And so, yeah, I think that's the future that I would like to see for ETH.
What if sending crypto felt more human? Pulse just launched Red Packets, a new way to gift tokens with meaning. It's gasless, gamified, and claimable inside group chats only. Think airdrops meet social cues on-chain. Backed by smart wallet tech and live across major L2s, Red Packets turn communities into microeconomies of gratitude and growth. No seed phrases, no friction, just connection with value. Check it out at pulse.social.
Okay, I know that we're running up against time, and I do want to get to talk about Lido V3.
Yeah.
And also, you're like growing integrations with DeFi.
Yes.
So can we get into that?
Yeah, let's talk about Lido V3. Okay, so I already mentioned in the beginning, I think a couple of years ago, people were like, there's only one way to stake, and liquidity is just the most important thing, and like everything else doesn't matter. Turns out that's not the case. So there's many more ways that people want to stake. And so the staking market is actually more fragmented today than it ever was. And so Lido, if you go kind of back, or even if you look like right now, before Lido V3, Lido is effectively, can think of it as like, it's a way to get liquidity on like a validator or like a staking setup, but it has only one collateral type, which is what we call Lido Core. So it's this like central place, where you give your money, and it's staked across many different node operators that all follow like relatively standardized rules. After Lido V3, we are creating a separation between this liquidity layer and the staking infrastructure. So you could say Lido becomes a platform. And so what this means in practice, so with Lido V3, anybody can create what we call staking vaults. And these staking vaults can basically be these are still node, like a validator kind of at the core, but you can use any setup that you want. So you can pick your own node operator, you can run any Ethereum sidecar that you want, you can charge any fee that you want, you can use it in restaking, you can use like only certain relays in MEV Boost, or you don't use MEV Boost, or whatever you want. And you can do all of this, and you can still get liquidity on that staking setup. And so that's a really big kind of innovation, because before everybody had to use the exact same setup in Lido to get the liquidity, and now you can use your own setup and you can control everything about it. And so it kind of even further closes this gap between direct staking and liquid staking. And there's a lot of use cases that would benefit from this. So, institutions like having kind of know your business rules, so they need to decide like, they need to select and like have legal contracts with very specific node operators, and they either need to be all in the US or like they cannot be in the US. So for example, we have like seen both of those. Maybe opinionated about the use of MEV infrastructure. They maybe want to get liquidity, and they have an agreement with a node operator. Lido charges 10%, so maybe they only want to charge like 2%, right? So now you can do that as well. And yeah, so there's many things that you can do, and you can like only use the part of Lido that you really care about, which is basically, the liquidity and the integrations. and the security. So yeah, that's what the main idea is behind V3. And yeah, it's going to go live in, it's rolling out in phases, and like it's going to go live in a couple months.
Interesting. Okay, so it's a more customizable version of staking, giving validators more control. And like the first thing that came to mind when you said kind of the geo fencing, or like picking where the validators are, is with ETFs and just like kind of like securities and regulatory concerns. Do you see this as a way to give more kind of traditional finance access to staking? For example, maybe BlackRock wants to issue a staked ETH ETF, but it hasn't been approved in the US, but maybe they can make that product available for kind of validators that are outside of the US, or using investors and just like a set that doesn't touch the US. Is that a potential use case as well?
Yeah, so I can't talk about BlackRock in particular, but in general, what we're seeing kind of from institutional customers that we speak to is that, they really value security, which is also why dual governance, for example, is like a big deal. But they also really value customization. So they may have specific demands put on them about like what node operators, for example, they can use. And so this helps them basically gain more control, so they can do this. But then also like liquidity really matters a lot in the institutional market, because they have to meet the redemptions, this is where we started the conversation, right? And so if you're an ETF provider or an ETP provider, you need to meet redemptions within 48 hours, for example. Then you're competing with the other providers on the APR that you provide, or the fees that you have to charge to your users. And the main lever that you have actually is like how much of your ETH you can stake. And so, between one provider using direct staking and maybe can like stake 25% of their ETH, and somebody else using liquid staking, they can maybe stake 75%. So that's a really big deal in the bottom line and in the competitive position that you can have in this market. And so, yeah, I think that, it's only, I think, a matter of time. Like, I think liquid staking is really good for institutions. And so, yeah, I think that we basically makes this even more, or like removes like even more roadblocks that kind of may have existed in the past.
So right now, what do you think the makeup is between your or Lido's stakers? Like, is it mostly retail stakers? And do you see that breakup moving more to institutions?
Yeah, so we did actually a study on this, an internal one, a couple months ago. And we only separated into like institutional customers and non-institutional. And it turned out that 25% of staked ETH is already used by institutions. So like even in its kind of, before dual governance and before vaults, like, staked ETH is still the most secure way that like you can do staking while also getting liquidity on this. And, just the ability to kind of use the staked ETH as collateral somewhere and sell it really quickly, like faster than you can unstake it, I think are two properties that are really valuable. Like a couple of days ago, we saw Lido being added as collateral in Maple Finance as well. So this is like a good example of this, because what it does is basically it was added as collateral. So like institutional clients can deposit staked ETH and they can borrow stable coins against it, so they can get leverage, right? So yeah, in general, just like staking is much more attractive when you can get when you can have a liquidity and when you can use it as collateral. And so, yeah, we try to, staked ETH is listed on most major exchanges. And so, you can use it on Binance or Bybit or like other places, right? And you can kind of use it to collateralize like the trading that you do. And so that's, the more venues that staked ETH is added in, I think the more useful it is for our customers.
So, okay, so that was already 25% of institutional stakers. Now with V3 and staked vaults, you probably see that percentage growing.
Yeah, I would think so. I think in general, like the markup of like institutional customers in DeFi versus non-institutional, I think is changing in that way, right? So I think that will affect Lido as well, but yeah, it will affect, I think, also everybody else.
Awesome. Okay, and now to wrap up and related to this, how do you see Lido to continue integrating into DeFi? Like, are there other protocols that you're working with, or how would you want it to see Lido continue to grow within Ethereum?
Yeah, so I think that Lido is already integrated pretty much everywhere. Staked ETH, I think, is the relatively clear leader in terms of integrations, it's been around 5 years, I think, by this point. Has existed already like I think 1.5 years before even the merge happened. And so, what you can always do is like give people more things to do with the staked ETH. I think that's a big priority. So I think in the past, Lido hasn't always been kind of open to, I think people who just want to maximize the yield that they can get on staking, like was more opinionated in the sense of, here's what we think is like a good kind of this is the best like standardized setup that you can get. It's kind of similar to like, people holding like the S&P 500 or something like that, right? But then there are people who want to, hold like the S&P 500 leveraged, or they want to hold like a more risky set of assets or something, right? And I think serving those folks' preferences as well is something that we are like trying to do now more than ever. And so V3 is a kind of reflection of that. It's basically giving other people the ability to use like staked ETH in ways that are much more diverse for users, right? So for example, if you look in like Morpho compared to Aave, Morpho uses this idea of a curator, and it's actually very similar with vaults. It's the idea that like a staking vault also has a type of curator. And so it's kind of more of a like, it's not necessarily like end users using V3, but it's businesses building on top that can make much more diverse products. And we're trying to make that as easy as possible. And so I think we really want to make it easy kind of to get like the absolute maximum yield that you can if you're into that. And I think you can expect more on that in kind of the next few months.
That'll be fascinating to see as kind of Lido becomes a place for not just stakers, but also businesses and, projects to build on top of Lido to make their own, staking protocols, like staking projects and dApps. Will be a really interesting evolution, which we will, of course, be covering at the Defiant. So Hasu, thank you so much for joining me. A pleasure as always, chatting. Really fascinating talk.
Always great to talk to you, Camila. Thank you.